Over the past 2 years, whenever the US stock market rose, the explanation was AI. When technology stocks reached new highs, the explanation was AI. When semiconductor valuations expanded, the explanation was still AI. But as of the market closed on July 20th, 2026, a change has emerged that deserves both attention and caution. The US stock market has not yet turned into a bear market, and capital has not truly left. However, the market's internal pricing logic is shifting. Over the past month, the technology sector has pulled back sharply, with semiconductors and highly valued AI stocks becoming the main drags on the major indexes. At the same time, energy, healthcare, financials, communication services, and consumer staples have continued to rise. This means that the market has entered a more complex phase. Capital still believes in AI, but it is no longer willing to pay an ever higher premium for the AI narrative alone. The market is beginning to look for a second major theme. This new theme does not involve completely abandoning technology, nor does it represent a simple shift toward defensive assets. Instead, capital is being reallocated toward companies that can continue generating profits, cash flow, and shareholder returns in an environment of high interest rates, high volatility, and elevated valuations. In other words, the market is beginning to demand proof from every company. 1. The real change is not that the index is falling, but that the stocks supporting it are changing. Over the past month, the technology sector ETF has fallen significantly, while the S&P 500 as a whole has remained close to flat. Looking only at the index, it may appear that little has changed. But once we examine the index's internal structure, it becomes clear that a significant handoff is taking place among its major sector weightings. Energy has delivered the strongest gains, but its weighting in the S&P 500 is relatively small. It can improve risk appetite and provide a hedge against rising oil prices, but it cannot support the entire index on its own. The sectors actually offsetting the decline in technology are financials, healthcare, and communication services. Together, these three sectors account for more than 30% of the index, and all three have risen during the same period. As a result, they have become the real sources of support for the broader market. The most important conclusion is this. The forces driving the US stock market higher are spreading beyond the technology sector and into a broader range of industries. The ideal market structure at this stage is not for energy to replace technology, nor for banks to replace semiconductors. Instead, financials, healthcare, and communication services need to continue supporting the index. Energy needs to provide additional upside flexibility, and technology needs to shift from declining to stabilizing. Only when these conditions appear at the same time can the index reopen its path to further gains. The real questions investors should now be asking are, which companies are positioned at the center of this sector rotation, and which stocks have not yet priced in all of the market's optimism? Based on these considerations, I believe 3 stocks from the energy, communication services, and financial sectors deserve to be added to the watch list. Chevron, T-Mobile, and Bank of America. 2. Chevron, a steady choice within the energy rally. Energy is the strongest performing sector in the current rotation. Rising oil prices, increasing geopolitical risks, supply chain disruptions, and improving refining margins have all contributed to the repricing of energy stocks. Some refining stocks have gained nearly 30% in a single month. Their short-term trends are extremely strong, but their share prices have also moved well above their moving averages. Investors who continue chasing these stocks at current levels may not be buying long-term value. They may instead be buying the final portion of the geopolitical risk premium. Chevron's advantage is precisely that it has not become the most speculative stock in the sector. It combines the cash flow stability of a large integrated energy company with direct exposure to higher oil prices, production growth, and tighter energy supplies. Compared with pure refining companies, Chevron has a more complete business structure. Compared with some higher beta energy stocks, its share price performance has also been more restrained. This makes Chevron a more suitable medium risk choice within the energy sector. When oil prices remain elevated, the factor that truly determines the value of an energy company is not how much crude oil rises on any particular day. The real question is whether the company can convert higher oil prices into free cash flow and continue returning capital to shareholders through dividends and share repurchases. Chevron has that ability. However, Chevron shares have risen for several consecutive sessions, and short-term technical indicators have become relatively overheated. This means that the stock remains in an upward trend, but it is no longer at an ideal level for chasing the rally. The appropriate strategy for Chevron is therefore to wait for the share price to move back toward its moving averages. If the stock returns to between $187 and $189 and stabilizes on lower trading volume, it will suggest that short-term profit taking has been absorbed. If it falls further to between $184 and $187, that range will become a more attractive primary position building zone. The key risk level is around $181. A break below that level would suggest that both the energy sector trend and Chevron's individual technical structure may be weakening at the same time. Chevron's core investment logic can be summarized in one sentence. It may offer the best balance among trend strength, cash flow, and risk control. 3. T-Mobile, a cash flow asset in communication services that has been overshadowed by the AI narrative. When investors think about the recent rise in communication services, the first companies that usually come to mind are Meta and Alphabet. But there is another type of company within the communication services sector. It does not depend on valuation expansion in digital advertising, nor does it need to prove to the market that it owns the most powerful large language model. That company is T-Mobile. The logic supporting T-Mobile's share price is more traditional and more direct. Subscriber growth, higher value per customer, expansion of its broadband business, and increasing free cash flow. This appears to be more closely aligned with the market's current preferences. As the market shifts away from chasing distant expectations and begins to place greater value on cash flow certainty, companies such as T-Mobile become more attractive. T-Mobile's most important advantage is that its revenue growth does not depend entirely on rapid macroeconomic expansion. Communication services are relatively essential. Consumers can delay purchasing a new smartphone and they can reduce spending on entertainment, but it is difficult for them to stop using mobile networks altogether. At the same time, T-Mobile continues to expand revenue through subscriber growth and higher average revenue per account, or ARPA. This gives the company a combination of defensive characteristics and growth potential. From a technical perspective, T-Mobile has moved back above its main short and medium-term moving averages. It has also demonstrated relative strength during trading sessions when the broader market was weak. This relative strength is extremely important. During a period of sector rotation, the stocks most worth watching are often not those that rise the most when the broader market is advancing. They are the stocks that remain resilient when the broader market is falling. There are currently two more reasonable ways to approach T-Mobile. The first is to wait for the share price to pull back to between $193 and $195. If the stock stabilizes quickly after the pullback, it would indicate that the breakout structure remains intact. The second is to wait for the stock to close above the $199 to $200 range. Once that level is decisively broken, the stock may enter a new upward trading range. If the breakout is confirmed, the next area to watch would be between $205 and $210. If the stock falls below $188 to $189, it would suggest that the current phase of relative strength may have failed. T-Mobile's core value lies in its ability to continue providing stable growth and free cash flow when the market's risk appetite declines. While Meta and Alphabet represent the imagination and future possibilities of the communication services sector, T-Mobile represents its certainty. 4. Bank of America. Not the strongest trend, but potentially the better risk-reward opportunity. The recent rise in the financial sector has mainly been driven by strong earnings, higher trading revenue, and a recovery in investment banking activity. JP Morgan delivered particularly strong results, but its shares have already experienced a rapid post-earnings rally. Goldman Sachs also performed strongly, but its short-term share price volatility has increased significantly. Under these conditions, continuing to chase the strongest stocks in the sector may not be the best strategy. Bank of America's value lies in the fact that its earnings were also strong, but its share price has not become excessively extended. The company benefits from the recovery in trading and investment banking activity, as well as from loans, deposits, and net interest income. This revenue structure is more diversified than that of a company that depends primarily on capital markets activity. From a fundamental perspective, Bank of America does not lack potential catalysts. Its share price has now returned to an area near its key moving averages, while short-term technical indicators remain relatively weak. This suggests that the stock has not yet re-entered a clearly defined upward trend. Instead, it is searching for a new support zone. This type of structure is not suitable for chasing the price higher, but it is well suited to evaluating the risk-reward profile. The area around $60 is currently the most important level. If the stock forms a long lower wick, a low volume doji, or a bullish engulfing pattern near $60, it would indicate that capital is willing to absorb the post-earnings pullback. If the share price moves back above $61.30 and then breaks through the $62.10 to $62.30 range, a new upward trend would be confirmed. The next area to watch would then be between $64 and $65.50. Conversely, if the stock closes below $59, it would indicate that the positive earnings results have failed to generate sustained buying interest, and the current investment thesis would need to be reassessed. The biggest difference between Bank of America and Chevron or T-Mobile is that Bank of America has already returned to a support area. Its risk level is clearly defined, and its downside is relatively easy to control. At the same time, if capital begins flowing back into financial stocks, Bank of America also has the potential to catch up with the sector's earlier leaders. The opportunity in this type of stock does not appear when market sentiment is at its strongest. It appears after positive news has been released, when the share price has neither surged out of control nor truly broken down. Bank of America represents a typical post-earnings opportunity. The fundamentals have already been proven, but the share price is still waiting for confirmation from capital flows. 5. 3 stocks representing 3 different ways to participate. Chevron, T-Mobile, and Bank of America all benefit from the current sector rotation, but they do not represent the same type of trade. Chevron is a trend trade. Energy is currently the strongest sector, and Chevron's fundamentals provide support. However, its short-term price has become relatively overheated. Investors should therefore wait for a pullback rather than chase the rally. T-Mobile is a breakout trade. The stock has already demonstrated relative strength, and the quality of its fundamentals and cash flow is relatively high. However, with earnings approaching, investors need to wait for breakout confirmation or for the first complete daily candlestick after the earnings release. Bank of America is a support-based trade. Its earnings quality was strong, but the share price has returned to an area near its moving averages. If capital begins providing support around $60, the stock may become a catch-up opportunity within the financial sector. In terms of trend certainty, T-Mobile currently has the most complete structure, followed by Chevron, while Bank of America still requires confirmation. This is precisely the market's most important trend at the moment. Investors must now distinguish among different price structures. Even when the outlook is bullish, some stocks are suitable for buying on pullbacks, some require breakout confirmation, and others require investors to wait until after earnings before making a decision. 6. Conclusion: AI is not over, but the US stock market is searching for a new support system. The easiest mistake to make in the current market is to interpret the correction in technology stocks as the end of the AI rally. But that is not what is happening. Capital has not rejected AI, nor has it completely left the US stock market. It is simply no longer willing to concentrate all of its risk in a single direction. Energy provides cash flow flexibility in an environment of inflation and geopolitical risk. Financials benefit from trading activity and the recovery of capital markets. Communication services offer both the potential of AI and the stability of recurring cash flow. Together, these 3 sectors are forming a new support system for the market. Chevron, T-Mobile, and Bank of America deserve attention because they meet 3 conditions at the same time. Their sector environments are favorable, the companies have their own catalysts, and their share prices offer clear confirmation and invalidation levels. A mature trading approach does not involve buying whenever positive news appears, nor does it involve chasing a stock simply because its sector is rising. As the technology sector corrects, financials, energy, and communication services are taking over the role of supporting the index. The next high-quality market advance may not come from a single sector surging on its own. It is more likely to come from several sectors supporting the market together while investors wait for technology to stabilize again. The US stock market has not lost its direction. It is beginning to move toward multiple sectors that are capable of generating cash flow. Cut through the noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.